Hey everybody, Sam Kwok here, one half of the Kwok Brothers, and in this video, I'm going to show you the math behind the accelerated banking strategy, aka using a line of credit to paying off your mortgage faster. Now, this video, I'm not going to hold anything back. I'm going to show you all the math. I'm going to show you it's not some magic, it's not some overhyped concept, but it's simply using and leveraging different financial products and tools that are available to us by the banks to maximize interest savings as well as time. Now, one thing that I do want to point out before we get into it is that this video is just for illustration purposes only. It's for educational purposes. I am not guaranteeing that you'll pay off your mortgage faster simply by following what I want to show you today, but it's simply an illustration of a concept with some variables and assumptions that I'll lay out clearly and transparently as much as possible. With that said, I'm also going to give you a way to also download this and get a copy of this calculator yourself so you can also play around and look into the math behind it. That being said, let's go and get started. So down below, you can see the disclaimer and disclosure, of course. Here we are, the Kwok Brothers Accelerated Banking Calculator. The first tab of this calculator is all variables and assumptions that I'm going to put in. I'm just going to scroll down and quickly show you what we're inputting here in the calculator and what we are assuming. So we have our mortgage information, any other consumer debt, start date, income and expenses, line of credit information, and then ultimately a section dedicated to giving us the potential results. So at the top, we're going to start with the original balance of the mortgage. Now, the calculator needs this to automatically calculate the principal and interest. It needs a starting point. So the original balance is basically the balance that you started out when you've closed on the loan or when you last refinanced. That was the starting balance of that loan. Now, the current balance is basically what is the mortgage balance as of today. So if you spent, last 2-3 years paying down your mortgage, obviously your current debt balance is going to be different than your original balance as depicted right here. Then we're going to go look at your interest rate. For this illustration, we're going to assume 3.5% interest rate on this loan, 30-year mortgage, and that gives us a principal and interest calculation automatically. Now, the P&I calculation is being done on a separate tab under amortization. So you can see an amortization table, which shows us the total mortgage payment, the interest cost, principal pay down, the balance, and the accumulated interest payment every single month. It's just a basic mortgage amortization table that you also get as part of the truth in lending statement that the banks give you whenever you close on a loan. You can also get this pretty much anywhere on Google, but we've put it here for calculation purposes because we need to calculate what the accumulated interest is, because that's the ultimate benchmark to see if we're saving money or not against the current mortgage that we have. So P&I is being calculated automatically for you by this calculator. Moving down below, this field or this section is dedicated to if you have any other consumer debt. Credit cards, furniture loans, solar loans, you name it. If you have any other debt, this is a section dedicated to that. For now, we're going to leave it blank for simplicity purposes to just show you the illustration of the math behind the strategy. Let's go and assume that our start date for this strategy, we're going to start implementing on September 1st, 2024. Down below is the income and expenses. And then right below that is the living expenses, which should not include your monthly principal and interest. The reason why is that the calculator is already factoring this in as a cash outlay, and I'll show you in a bit as to how that's being treated by the calculator. So $12,000 net monthly income, $8,000 is purely living expenses, and again, for transparency purposes, that should also include your taxes for your property taxes, as well as your insurance escrow. Knowing that this only calculates P&I, it's only fair and accurate to add the escrow payments as an expense under the living expenses as well. So keep that in mind when you decide to download this later and play around with yourself. So keep that in mind as you download this calculator later and you're playing this with your own numbers. Down below is the new line of credit information. So this is the HELOC, PLOC, business line of credit, whichever line of credit you choose to use for the accelerated banking strategy. This is where you're going to go and input those variables. So the amount we're going to use, okay, if you're doing the chunking strategy or the second lien position HELOC, you're going to put the amount that you're planning to chunk against the mortgage principal balance. So for this illustration, we're going to go and assume $20,000 for the principal chunk. And for the line of credit interest rate, we're going to put 8.5%. I just checked through Bankrate that the average interest rate right now across the United States is about 8.5% for second lien position HELOCs. Now, we're going to come back to this later as a second scenario or a second illustration, but I also want to show you a different illustration of what happens if the interest rates on the line of credit were to increase every single year. So stick around for that because I'm going to show you what that looks like as well because it gets really interesting. Down below are the potential results. So this is just an estimate illustration of what could be possible. But based on the inputs of the calculator, we have an approximate payoff date of January 16, 2033. Not bad. Because originally we were going to pay this mortgage off, I believe October 2044 is when we're going to pay this off. But our new projection is now January 16, 2033. We're going to pay this off in about 8.4 years. Originally, we were going to pay $138,157.53 of interest, but because of this strategy, we're using accelerated banking, we are now saving $79,889.07. Okay, and if we had any consumer debt, we would have also factored that in as well. But because we didn't, it's just $79,889.07. Okay, so the rest shows you what the tip is, the total interest percentage, which is basically taking the total interest amount dividing by the principal balance. So that's what we're also looking at. So now the question is, how did this happen? What's the math behind it? What's the process? Because I know many of you want to see the step-by-step process, the math, the equation as to how this works. So like I said, I'm not going to hold back. I'm going to show you every single cell, columns, and rows as to how this math is being calculated. So let's go over to the daily tab because this will show you under the hood, behind the scenes, curtains pulled all the way back to show you why the math works in the way that it does. So like the assumptions I showed you, we're working with $12,000 of net income. Well, we all know that most Americans get paid bi-weekly, right? First to 15th, or it's first of the week and third of the week. Right? It's almost always bi-weekly pay. So what the calculator assumes that in this illustration, that the fictitious individual is getting paid on the 1st and the 15th day of the month. So you'll notice that on the first day of the month, September 1st, okay, they get paid $6,000. Okay, I'm gonna use red. Red is better. Okay, and then on the 15th of the day, or 15th of the month, excuse me, they're also getting paid another $6,000. And then the living expenses come last. I'm going to show you why we put $8,000 all in lump sum in just one sec. And I'm also going to give you some different illustration to make that a little more realistic. So right from the get-go, okay, we have our $350,000 current balance for the mortgage. Okay, we established that by this variable right here, debt balance. Okay, and this cell is simply just getting this variable, which is this right here. Okay, combined mortgage and consumer debt. That's basically all it's doing. So $350,000 current balance, income is $6,000, line of credit interest rate at 8.5%. And then what we're doing is we're taking the $20,000 of the line of credit that we have available and making a principal payment on the mortgage. So you can see on this column, debt balance column, we went from $350,000 now down to $330,000 because we're taking that $20,000 from our line of credit to the principal balance on our mortgage. Got it? Now, what that does is that we now have a balance, but we also have income that is offsetting the line of credit balance as well. So remember, the whole premise of the strategy is that we're going to take all of our income and make a principal payment deposit into the line of credit. Now, I'm going to make sure I get clear with my language because I know I like to throw words around. But in this scenario, from a technical standpoint, it is just a principal payment that we're doing inside of the line of credit. So we've done the $20,000 line of credit principal payment against the mortgage. We're taking our $6,000 of income and making a principal payment on the line of credit. Therefore, at the end of the day, we now have $14,000 in our line of credit balance. Subsequently, because we had to talk about the daily balance and daily interest, we are now charged $3.26 on this line of credit balance of that 8.5%. Now, just to show you that that's not some made up number, again, this is using calculations just like this. It's taking this balance times this divided by 365, okay? You guys can follow along with me if you want with your own calculator just to prove that this calculator is not tainted or biased, right? It's just purely math, okay? So $3.26 is what we're paying pretty much throughout the 15th, where we have another event of $6,000 of income paycheck deposited into checking account. We're taking that $6,000 and depositing into the line of credit balance, which subsequently lowers the balance down to $8,000, which translates to lower interest cost, same interest rate, right? But our interest cost is significantly lower. Does that, you see that? From $3.26 every day, now down to $1.86 every single day. Okay, that's in this average daily interest column. Okay. Now, what about the expenses? And I'll explain this in a way it works for our strategy, but also I'll explain it from a realistic and transparent standpoint. So down here on the 27th day, okay, we have a lump sum of $8,000 of living expenses that is drawn from the line of credit. So you can see it increases our line of credit balance, subsequently increasing the cost of interest as well at a daily level. Now, you might be asking, okay, Sam, why did you put $8,000 in a lump sum? Is that realistic? Who, spends all their money in one day out of the month? Well, the reason why I did it this way is because what we teach to our client, or what we at least suggest to our client, is that rather than drawing from the line of credit for everyday expenses like gas, groceries, trips to the theater, whatever the case might be, instead of doing that, because if you do it that way, you're making draws from the line of credit, which increases the daily interest. Rather than doing that, put it on a credit card, which the interest on the purchase isn't accrued until the next billing cycle. All the while, another benefit of that is that many of these credit cards have points, cashback programs that could also offset some of the costs on the line of credit interest. So that's something that we suggest to our clients at least, where you consolidate all your expenses into the credit card in a way that on the very final day, or whichever day on the month, you're paying all of your expenses in lump sum, because all of your living expenses are tied up with the credit card. Now, I also understand from a realistic and transparent standpoint that that's not always possible, that there are bills and other loans or other credit that you're paying for that cannot be paid using a credit card, right? So let me go and illustrate that, okay? Let's say we can't pay all of it on a credit card. There's certain bills that we got to pay throughout the month that just has to be paid out of the checking account. So in that instance, we're taking the funds from the line of credit, moving it back to the checking account, and the checking account is what's paying for not only the credit card bill, but also some of the other bills that we have. So I'm going to go and actually illustrate that for you. Okay, instead of this $8,000 lump sum, we're just going to put, $7,000 here. Okay, we're going to scatter some of the expenses out here. Okay, not 2,000, but 200, 500. Oop, keep adding extra digits. There we go. 500, and the last we're going to put 300 over here somewhere. Okay. All right, we're going to spread it apart, just to be transparent and realistic to an ideal scenario, okay? Now, basically, if we stuck with that, we're seeing interest costs increase on these days that we're drawing from the line of credit, but it's still better than paying $3.26 all the way throughout the rest of the month. Does that make sense? So we can keep repeating these events, okay? So $300, here, 500 here. Okay, I'm just gonna scatter them around just so that I'm being as realistic as possible. And obviously, you would have to do that throughout the entire process of using this strategy. So even by doing that, by adding some of these, scattering them out, okay. And I know I'm being unfair by not showing you the rest of the way, which you guys can do, but it doesn't have a whole lot of impact on the payoff. It doesn't. It saves us a little bit less on interest, but regardless, this is a pretty significant bite, or a massive amount. So I'm trying to illustrate this as realistic as possible for what actually happens with our clients that we work with to help them implement this strategy. I know some of you guys are also asking, what about the interest and the mortgage payment? So here it is, okay? Here's the actual interest on the line of credit, okay? Because I know some of you guys like to make that argument of, well, Sam, what about the interest on the line of credit? Now we have to pay that too. Well, okay, yeah, here. So we're going to take that $79.79 that we've basically accumulated over September for this illustration, and we're adding that into the line of credit balance, okay? So this is what's happening. The income column acts as a minus. The monthly interest acts as a plus. This acts as a plus, that's a plus to the line of credit balance. So what the calculator is doing, if you look at the actual formula, it's basically taking all these different variables and doing pluses and minuses. That's basically what it's doing. And then giving you what the balance is. And then it's doing the interest calculation based on what the final amount is. Okay, so we can actually do the math yourself. You can pause this video and do the math to see if this calculator is accurate. You're more than welcome to do that. What we're basically doing is we're taking $16,000 line of credit balance minus the income, add the monthly interest plus the payment, which consists of the interest and principal balance. And the final balance we get, I know it's kind of hard to see with my writing, The final balance on the line of credit get is $12,100.44. And the interest is reflected of that 8.5%. Okay. So that's the math behind this strategy. That's all it is. Okay. Yes, it does rely on the fact that you need to have positive cash flow. If you do not have positive cash flow, this strategy will not work. You'll actually go backwards and you lose money. And this is not a good scenario for that. So if you have positive cash flow on an annual basis, average basis, then yes, this strategy can be powerful. Like I said in many of our other videos, is this strategy for everyone? No, it's not. Okay. I wish it is, but it's not. It's just like any other financial strategies and concept. Not a single financial strategy can be applied for every scenario, every situation, for everyone. But for those individuals that have good cash flow coming in, you have your finances in order, you have a mortgage, you want to pay it off as soon as possible. If that is your goal, this strategy can be a powerful tool and enhancement to what you're doing with your financial journey. And again, this is just an illustration to show you what's possible. How you implement is going to be different based on your needs and your situation and so on. Okay. Now, I promised that we're also going to do a second scenario where we're going to put some extremes in. Okay. We're going to stress test this as much as possible and introduce some risks. Okay. Let's just say we're in a interest increasing environment like we saw in 2023, where interest rates are continuing to go up. So let's just say the interest rate every single year is going to go up by, let's say 50 basis points, by 0.5%. Okay, I'll show you what it looks like even with more extremes. All right, 8.5%. So next year it's going to be 9%. The following year it's going to be 9.5%. It's going to continue to increase. And I'm exaggerating this a little bit because I want to show you, even with some risks and dangers that we're artificially adding, that this strategy has some endurance. Okay, so let's go and scroll down to see what the results look like. Okay, we're still at about 8.4 years. Pretty darn good. But you notice that we are losing some interest savings by about $3,000 to $4,000. But we're still saving $77,000 of interest and shaving off a lot of time in paying this mortgage off. Still pretty darn good. Better than, waiting until 2044 in this illustration. We're still saving a lot of money. Okay, let me push the envelope a little bit. Let me go to, let's say 1%. Okay, every single year, let's say we increase by 100 basis points, which isn't realistic. But again, I'm just exaggerating. Okay. So look at this. All right, it's still 8.5 years. We're pushed back a little bit to February 16, 2033, lost about a month, and we're at $74,000 of savings. So we lost additional about $3,000 of savings. Pretty darn good. Now, at the time of this recording, we are anticipating interest rates to come down, right? So obviously this is not going to be realistic at the current context, but I'm showing you, even if the interest rates were to continue to go up, that this strategy is still a powerful strategy. Mind you, that we started out at 3.5% mortgage rate. That was our mortgage interest rate. But even with an 8.5% HELOC and an ever increasing 1% interest rate, which again doesn't happen, I hope it doesn't happen, this strategy can still help you save money. Okay, given the assumptions and the variables that we are introducing. And just to show you that the interest rates are going up, again, I'm going to show you next year in 2025. There we go. See, we went from 8.5% to 9.5% on the anniversary of us implementing the strategy. And yet here we are, we're still saving money. Okay. And so again, I'm just trying to try this as much as possible because I know a lot of you are skeptical, a lot of you are doubters, which is good. You ask questions, okay? That's how you learn, right? And I know there's a lot of content creators out there right now that likes to over-exaggerate the benefit of the strategy. It's not, it's just math, right? It's just we're using a tool that allows us to basically, I don't want to use the word manipulate, but basically to control the average daily interest cost, whereas with a mortgage, it's hard to do because if you try to do this with the mortgage, then you can't get the money back out because it's, mortgage is a closed-ended, loan. We're unable to, again, I hate to use the word manipulate it, but we're unable to manipulate the daily interest cost, which is where the savings come from for this strategy. So having said that, yes, this strategy still works even with an ever increasing 1% increase, which is, I know, wild. But if we were to dial this back to 0, right? Or maybe let's do the opposite. Maybe we're going to see a decrease of 0.25% in the next couple of years because of what the Federal Reserve is doing. Then we get, better results, right? So, but again, I'm just trying to be realistic as possible, keep it at zero. And based on that, we're saving about $8,000 of interest. Now, again, this is just an illustration. It's what's possible, not a guarantee. For many of you, this strategy is not going to work, and I would encourage you to stay away from it. But for many of you that have a particular financial situation, okay, good credit score, good cash flow, you have a well-paying job, yeah, this strategy could work for you. If you need help implementing this strategy in your finances, that's what we're here to do. If you want to download this calculator, I'm going to leave a link down below in the video description. It's chopmymortgage.com. Again, that's chopmymortgage.com. I know it's a little funny link, but chopmymortgage.com is where you get a free copy of this calculator, although you will not get the daily tab, okay? But you will be able to see the results, the estimates, based on the variables and inputs that you make on these yellow cells here, okay? The reason why we don't give away the daily tab is we reserve those to our clients to give them the tracking mechanism. And we're also working on a software and app for our clients to be able to automate a lot of the tracking for them. But we're gonna give this away for free to at least for you to play around with the numbers and see what it does for your savings and time and all that. So go and check it out down below, chopmymortgage.com. We also give away hundreds of free videos about the strategy, all the questions that you have about using a line of credit to paying off your mortgage faster, which we here call accelerated banking. So again, if you have any questions, please leave them down below. We'd be more than happy to answer them for you and clarify anything that might be missing. I hope I did a good job. I didn't hold back. I explained as much as possible, gave you different illustrations, and exposed a lot of different things behind the scenes. Even then, I'm not a perfect teacher. So let me know in the comments down below if you have any questions. So with that said, we'll see you in the next video.